to change it to the All right, welcome everybody that's joined us. I appreciate you being here. Um, it's going to be three topics today. It's not really a huge day, but they're three exciting topics. And every time I say exciting topics, I might not even show it in my face, I've been told. So I need to be more excited, more animated. It's kind of like the character that one of his comedy sketches is that he's deadpan constantly. I need to learn not to be deadpan so I can do a little bit better. So anyway, thank you for all for being here. It's hard to read all the people that are here. It's great to see y'all. Robert's taking attendance over here. So as he sees your name, he's marking you, getting everybody on board. So let's just launch into topic number one. I think it says 9 concurrent people right now, even though we've seen more names. I think YouTube's a little bit slow in getting everybody listed as having already gotten into the channel yet. So that's good. That's good. Okay, so Nick, David, Kilron, good group of people. Okay, so first topic. We are going to launch Ethereum tonight. And Ethereum, the launch is going to start taking aim at challenging Visa and MasterCard. Now, let me explain what that means. Taking aim at Visa and MasterCard, the complaint has always been that the public blockchains like Bitcoin can't hold a candle to the number of transactions that Visa and MasterCard can do. Well, that is about to change, and it's going to change in a significant way. What's happening is the merge eventually will allow Ethereum to go for at least 200,000 transactions in a day. Pardon me, in a second. So 200,000 transactions per second is going to allow them to actually do more transactions than the Visa network and the MasterCard network both. Not combined, but either one. It's going to put competition into the mix. So you're going to be able to see a direct competitor to those two big those big credit card companies. So let's take a look at it. What's happening right now is the Ethereum merge is in a countdown. It right now is estimated to happen at block 15,537,351. That block, based on how long it's taking to close blocks, is going to happen tonight at 1:16 a.m. So the morning time at 1:16, and I believe this time frame that they have here, and maybe somebody can calculate 7 hours and 11 minutes from now to confirm this. I believe that is Central Time that it's listing there. Now, the countdown also shows that there's 1,810 blocks to go. They're currently at block 15,535,541. So this is kind of a neat chart to see what has actually happened. But why is this important? Why is this actually significant in the idea of blockchains, and especially public blockchains? And so what I want to do is go ahead and pull up an article, some articles that I've put together. And this one is on the merge. Now, it's the most significant upgrade of Ethereum in its entire history. It is where Vitalik Buterin wanted to be at the very beginning when he started the Ethereum network. Now, the point here is that they started with proof of work because they needed to have a hardened network in order to keep out, hackers. And you don't really hear of the Ethereum network itself being hacked. what you hear about is companies that have built smart contracts and DeFi applications, distributed finance applications, on the network, and they haven't hardened those for security. And because they haven't hardened those for security well enough, they are getting hacked, like Axie Infinity and several others that we talked about in a prior video. So what's going to happen is, you see the graphic there on the screen, that proof of work is continuing. But back in 2020, in order to start this whole thing, they started what they called the Beacon chain, and it has been running parallel, processing the same transactions as the Ethereum network. So it has been running since 2020 and has been tested over and over and over again during the last nearly 2.5 years. So the Beacon chain now is going to merge with what they call the main net. And the Ethereum mainnet is what has had all of the transactions prior to now. So the whole point of the merge is to merge the Beacon chain and the mainnet together. And what will end up happening out of that merge is the Beacon chain will take over as the way that consensus is done for the entire Ethereum network. Now, the effect of this immediately is not going to really show itself. The effect of this right now doesn't really speed up the network. It's just a different consensus method. It, unfortunately, immediately is not going to lower the cost. In other words, the amount of gas that it takes in order to close a particular transaction isn't going to be affected right away. But coming right on its heels is what they call an upgrade that will introduce sharding. Now, sharding is something that I was not very familiar with. But what I'd like to do is put Robert on the spot here for a moment. He's got his microphone right next there. And he'll explain what sharding is or was in the aspect of a particular game that he saw it implemented in. So Robert, can you share with us a little bit about that?
Sure. I've just enabled the second microphone. If it's too loud or sounds a little bit off, please let me know. No, sharding is a technology that's been around for at least a decade in other contexts. It's used a lot in large video games, especially ones that need to keep an online presence, MMOs in general. But it's the idea of being able to have multiple instances of the same world at the same time where people can split and merge. That are allowed to split and merge at various times to keep population held correctly. So I'm imagining that in this context, you just saw the
I just read it. Yes.
In this context, it allows I'd imagine it would be allowing Ethereum to handle a significantly higher volume of transactions through shards of the blockchain that would later be merged in.
Okay. So what happens when the sharding is introduced is that's when the capacity of the network increases dramatically. Now, the whole reason for the amount of gas that it costs per transaction is the amount of capacity on the network. So by reference, by inference, you can then think of an increase of capacity as then a decrease in the amount of cost that it takes to get a transaction through the network. So basically what's going to happen is as the capacity increases and the number of transactions can be pushed through the network, the increased number of transactions is going to lower cost because the consensus method allows it to go faster and the sharding allows it to go faster as well. And the number of transactions increasing, basically supply is increased, therefore demand decreases, and a supply and demand curve just automatically drives the price down. So generally what we're talking about here is the ability for Ethereum to start competing with Visa and MasterCard. The second big thing is The reason it can compete is because of increased capacity and lowering of costs to run the data through. Now, understand, Visa and MasterCard charge almost an arm and a leg for all their transactions. So if you have microtransactions through Visa or MasterCard, it can cost you half the amount of the transaction for a vendor to run the cost through, because usually there's a per transaction fee and there's a percentage fee. So you'll pay 1 to 1.5% for each transaction plus 25 cents. Well, if you've got only $1 transaction, like you've got a little kid here that's decided to buy a little something with the money that they've earned from whatever around the house, they, cost the company essentially more than their profit that they make off the item in order to do that transaction. So Megan's having to take off. Okay, so basically that's what's happening with the merge. It's an exciting time. Oh, I can't express how excited I am to see this happen. I did put some Ethereum into the beacon chain in ETH2 so that they could help perpetuate their chain. And so that chain has been operating for a while on staked coin from about January or February, somewhere in there. And so when it merges, it'll be there and it'll be available. It'll pay people to stake their coin. Right now it's paying 3.25% to stake your coin, and you get paid back in Ethereum 2 coin. Eventually Ethereum 2, the moniker 2 will go away. It'll just be Ethereum. There's not another coin being created out of this merge. It's just going to all be Ethereum eventually. Right now they're differentiated until the merge is complete, but after that it'll just be Ethereum. So that's the skinny on what's happening with Ethereum tonight. And I'm going to go for a little 2-minute break. As soon as I come back and after I adjust some technology here, we'll come back with our next topic. All righty. Well, the article that tickled my fancy this time was the article submitted about Celsius and how Celsius is in bankruptcy court right now, and
Sorry, guys, we were missing a camera there for a moment.
yeah, exactly. So you saw me go off screen for a moment and come back. Okay. The article that tickled my fancy out of all the submittals this week was the article on Celsius and how it went bankrupt. And what I need to do here is kind of lay some foundation as to how number one, these networks went bankrupt, because we're talking about not just Celsius, but we're talking about Voyager, and we're talking about Voyager, and who else was a big one? Okay, I'll catch up to it. It's in the article here. There are several that are in bankruptcy court right now. Several meaning about 5 or 6. The big ones are Celsius and Voyager, and Three Arrows are the three. Now, Celsius was what they call a DeFi or DeFi app, a distributed finance application. Now, one thing about distributed finance applications is they want to act like a bank. The problem is that they're not a bank. They are a blockchain application on the Ethereum blockchain. They're using smart contracts. So what's happened here is Celsius was a coin, and you can still see Celsius as a coin on all the exchanges. It's still traded. It still exists. Even though they're in bankruptcy, the company is still active and still working. The problem that happens, though, with these kind of applications is that they are not banks. And that's a problem, because people think of it's finance, they're paying me interest, therefore it's a bank. But it's not. And part of the challenge, of course, then, is in regard to how they react when the company starts having troubles. Hey, Robert, could you go over there, find my picture, and pop it up, because the picture has my next thing that I want to share. Okay, so here you are with Celsius. Now, Celsius basically got their start right around September of 2020, and as they gained investors, of course, the market was going up. Okay, so here you have the market going up. They filed for bankruptcy over here in July of 2022. So in July, they're filing for bankruptcy. Why? Why are they filing for bankruptcy? Well, the problem with a crypto company is that they're new and they're not regulated. They ran their business like any other business. They took the money, fiat currency, dollars in this regard, they went out to investors to get money to fund their operations. So they're paying payroll, they're paying for computers, they're paying for facilities, all of the things that a normal business pays for. That costs a certain amount every single month. So what ends up happening is when you're riding high up here and Celsius, the coin, is going really, really well, they're actively investing that coin in other options that they have. They invested in Voyager. They invested in the other one that I mentioned, Robert. Three Arrows. They invested in Three Arrows. Both of those were, Three Arrows in particular was a venture capital firm that helped these other companies to get off the ground. Okay, so the challenge then is, how is Celsius, the company, going to take money from investors, you and me and bunches of other people, 100,000 clients they said they had at the peak of their business, So when we invest in them, we're thinking that they're a bank and they're going to pay us interest. They were paying as much as 17% interest on the coin. Okay, so here's the kicker though. If you put $1 in a bank and you're getting 17% back per year, you expect $1.17 at the end of the year. If you invest one Celsius coin, no matter what the value of that coin is in fiat currency or in dollars, you invest $1 of fiat coin. Let's say you invest $10. It'll buy about 1.2 coins if you buy the coins up here. And they're going to pay you back 1.2 plus 17% interest after a year. Okay? Now, after a year, well, they didn't even last a year before the turn down in the cryptocurrency market happened. And all of a sudden, the value of the coin is going down. So, now let me go back to the article. Here we have the story of Kristen Ostheimer, a 37-year-old living in Connecticut, wrote in a letter to the court, says that he put his entire retirement savings and lost more than $30,000, which has brought him into insurmountable tax complications. Now, I don't know what kind of tax complications he could have by losing a bunch of money unless he took his retirement savings out and he has to pay taxes on the $30,000, but he doesn't have the $30,000 anymore because the coin value went down. Well, part of the challenge with that then is he bought a certain number of coins, the Celsius coins, with that $30,000. The Celsius coins went down in value, and even though he was promised that he would get paid 17%, he was going to get paid 17% of the coin's value, the Celsius coin's value. So for every one Celsius coin that he bought at the end of the year, he'd get 1.17 Celsius coins back. So I'm going to pop up my graphic again here. So you've got a Celsius coin now that's worth down here in the 50 cent category, and he bought it, let's say, up here in the $7, almost $8 category. So now he has, let's say he has 100 coins that he bought at $7.50. Let's say 100 coins at $8. So he put in $800. Down here, they're only worth 50 cents. So down here now he's saying, well, doggone it, I put $30,000 into there. Okay. Now he owes taxes on $30,000 because he took out the money out of his retirement fund. I don't know if Celsius had a retirement or an IRA-based function. I hadn't looked that far into Celsius. I don't know if I could even find it. Probably did not, because you have to be able to be registered with the IRS to build a fund that can be labeled as an IRA. So I doubt that Celsius was that sophisticated, as young as they were. So he invests $800 here. Now it's worth only 50 cents of that $8. So it's now worth only $50. So he's lost $750 of value here. And doggone, he's going to get 117 coins at the end of the year, but that extra 17 coins is only going to be worth $34, or actually $8.50 because it's 50 cents. So you've got a situation where people are losing meaningful money, but it's not necessarily because of what Celsius did wrong. The problem with Celsius being in bankruptcy and why they're being accused of being a Ponzi scheme is they kept on taking investors in, and of course when people wanted to withdraw their money, they kept paying the investors, they kept on paying those investors out. The money going in and buying the Celsius coins probably was not tied to a particular individual. In other words, they didn't create what they call custodial accounts. So basically when you deposit money in a savings account, the bank keeps track of the fact that you have a certain amount deposited in a savings account. But frankly, that money gets loaned to people to buy an auto or to buy a house. That money, even though on their ledgers it says that you have deposited that amount of money, it doesn't necessarily mean that the same dollars that you deposited are the dollars that you're going to get back. So it could be said that a bank is a Ponzi scheme too, because you'll deposit those dollars, but you'll get different dollars back if you decide to withdraw it. And if the bank was going bankrupt or there was a run on the bank, it could be said that they're a big Ponzi scheme too. The whole point is that they kept paying the depositors who wanted to withdraw out of the funds that they had available. And that some of those funds that they had available could have been coming from current depositors to pay people who had been there a long time and were leaving the platform. Okay. And frankly, there were a lot of people leaving those platforms because the coin values were going down and there was essentially a run on the bank and they ran out of money. Now, part of the challenge here that ran them into bankruptcy is that because they're not regulated, a lot of times they will go and convert what coin they have into dollars, and they will go invest in a Bitcoin firm, and they'll buy Bitcoin to put on the shelf as collateral and so forth. So converting it to dollars and then investing it in another crypto company, and if that crypto company goes bankrupt and they can't get their money back, all of a sudden they've got depositors' money that's been invested so that they can pay them the 17%, and it's lost, it's gone. So you see later on in the article that they had as many as 100,000 creditors here, listed here. The other article here talks about the fact that by the time they filed bankruptcy, where they at one point had $4.7 billion in customer holdings, they ended up with $5.5 billion in liabilities, and by the time they filed bankruptcy, they only had $167 million in cash on hand to start paying those liabilities. That's what you call bankruptcy. You are so badly upside down that you can't see your way out of it. So the bankruptcy court right now, of course, is taking testimony from all the people that lost. That's a normal thing in a bankruptcy court. So what will happen now is Celsius will either continue working on retrieving as much money as they can to pay their creditors, which means basically to pay the people who deposited with them, because all of them are creditors at this point. They'll keep either trying to accumulate that money and paying it back, or the courts will basically say, you're too badly upside down, you close your doors and we'll just retrieve what we can and pay off the creditors. And they're badly upside down enough that it looks like they won't recover from it. So let's see here. Yeah, they were involved with Three Arrows Capital, who went bankrupt. They defaulted on their loans, and Voyager's in bankruptcy as well. And all of them were kind of interlinked, which caused a lot of the problem. So here's another situation where, and it's a cautionary tale, you don't involve yourself in risky investments, because basically, if it's too good to be true, it probably is. 17% is a lot of return on an investment that supposedly is guaranteed. I don't know what guaranteed means in the distributed finance world, because there is no guarantee when it comes to cryptocurrencies, period. And so I've been very reluctant to get involved in any cryptocurrency that is in a distributed finance application at this point, because they're just too new. They're just too immature at this point. And frankly, I like to see some maturity. I'm not an early adopter or a person who really involves themselves with the beginning end of any technology. Now, I am involved in blockchain. You could say that's an early technology. I am involved in cryptocurrencies. I like to play around with them. But the bulk of my money is not there, definitely. And won't be there until it matures an awful lot. Okay, so that's the story of Celsius. So what we're going to do is we're going to go ahead and take a little bit of a break, a 2-minute break again. We'll set up for the next segment, and we'll look forward to seeing you on that side. Post your comments or questions in the chat window, and we'll take those questions and answers when I come back. Okay. Alrighty, well, things are heating up on the Central Bank Digital Currency Fund, that CBDC we've talked about before. And right now, the situation is really firmly in the camp of the Federal Reserve right now. A CBDC, a central bank digital currency, just to make it simple, is a digital version of the dollar. Now, being a digital version of the dollar, hopefully you and I can then be able to, open up a wallet like we would Bitcoin and be able to trade. It would be a lot like the wallets that you have that you can put a credit card into and scan at the checkout register at various businesses. Apple has Apple Pay, Samsung has Samsung Pay, Google has Google Pay, and they can be applications on your phone, and you can set up your phone so that it puts out a small signal to the kiosk area there, and you can then pay for your groceries and various items, right at the check stand. That's the kind of technology we're talking about, only it would be raised up a level to where the dollars would actually be in the wallet on your phone rather than a credit card that went through a credit card clearinghouse that then goes to your bank if it's a debit card, and then the money gets taken out and sent to the company. In a central bank digital currency, it would work like a blockchain. And a blockchain would just be a direct transfer straight from your wallet on your phone that you've loaded with dollars, of course, and then would go straight to the vendor. So it cuts out a lot of the intermediaries and could make things a lot more simple. Well, the idea, though, is the challenge with this is the fact that a central bank digital currency is controlled by the government. And being controlled by the government would then be potential for identity theft, actually for privacy issues mostly. The fact that if the government actually issued it, then if the U.S. Treasury actually issued it, then we would end up in a situation where they could look at the blockchain and see what we spent at Walmart 2 seconds ago, if they were that curious about our spending. So privacy issues have been raised because of that. And I talk about this extensively in another... I forgot to turn on the camera.
Okay.
All right.
That's okay, we'll re-record later.
Okay, we'll re-record later. Okay, we'll record the beginning of this later. So the central bank digital currency, if it was issued by the Treasury Department, is part of the government. If it's issued by the Federal Reserve, though, Federal Reserve technically is not part of government. It is a bank unto itself. Now, you might find that a little hard to believe because it seems to function like the government. It seems to act like the government and definitely supports the government in a lot of different ways by making sure the Treasury has enough money to continue to pay its bills. When it borrows, it usually borrows from the Federal Reserve, or it borrows from people who buy their bonds. Either way, either one or the other, the Federal Reserve either buys the bonds or individuals buy government U.S. bonds. So it's simply a situation where the Federal Reserve at this point is looking into the issue. So we know that President Biden issued an executive order for the Federal Reserve to look into the issue. They are currently looking into the issue. They've put out a white paper that you can go get at the Federal Reserve on central bank digital currencies, and it talks about what the future of money is going to be. It's called the Future of Money Report. So this article is a little bit older because I've actually downloaded the article and the report. So the Treasury Department's not really getting into it much, but the Federal Reserve is where you can actually get the report from. The CBDC decision belongs to the Federal Reserve, as it says here. So Jerome Powell, if he's still in office at the time of the decision, would be making that decision to issue a central bank digital currency. Now, the challenge here is that Congress is getting a little bit uppity about it. Congress is wanting to know what the Federal Reserve has in mind. So Patrick McHenry, who is on the Financial Services Committee, sent a letter to the Federal Reserve because of the new chairwoman that was just put into the Federal Reserve, onto the Federal Reserve Board. So her name is Lael Brainerd. So she was just questioned, and during her testimony at the Congress, she basically said that they would not be acting on issuing a CBDC without strong support from the White House and Congress, adding the agency had no intention of serving consumers directly. So that seems to say that even though the Federal Reserve has the final say on it, that the government would be actively putting the legislation in place to create it. So the question is that there's a lot of confusion in that, because normally the Federal Reserve, issues money and takes away money out of the economy, at their own whim. They manage all that side of it, and the Congress really doesn't get much involved, other than to create the Federal Reserve back in 1916. So the question was asked from the member of Congress, is it your view that the Federal Reserve may not establish an intermediated CBDC model without direct authorization from Congress? So they want to know if Congress has to authorize the Federal Reserve to do so. And so they're asking that question. Also asking for more information on the Federal Reserve's position concerning the central bank digital currency. So Jerome Powell said later that they haven't made any decisions at all about whether we should have a CBDC yet. So they're still in the question phase, they're still in the comments phase, and being in just the comments phase, there's really not a lot of information, although you've got a lot of people asking questions. And of course, as it gets further down the road, there's going to be a lot of questions as people get interested in knowing what this new thing is going to look like. There's a lot of groundwork that has to be laid. First off, it doesn't happen overnight that you can put a nationwide blockchain in place that will handle cryptocurrencies. You have to put all the nodes in place, and I could imagine that the nodes are going to be banks. They're going to be those main nodes, and that in order to get an account, you're going to have to validate yourself, so it'll be acting a lot like a private blockchain in the respect that you'll have to create an account, you'll have to identify who you are as. The know your customer laws will be enforced in having a CBDC account so that you can then transact in digital currencies, in the central bank digital currency or the dollar. So there's a lot of groundwork to be laid, a lot of testing, and a lot of work that has to be done before it can even get deployed once a decision has been made to actually do it. So we've got a lot of road to tread here. How fast they can do that is really questionable. I know most government projects usually take about twice or three times longer than what they say they will. So it's definitely not going to happen overnight in any case. So I'm going to go to a couple questions we have. Esteban asked, so the Fed keeps buying more bonds and people scratch their heads over the cause of inflation. Yeah, that's true. Yeah. Did you see the CPI report? The CPI report this last time was not glamorous. It was really interesting to watch the stock market react to it. In fact, I have a video that I recorded yesterday that I'll post on my Pharos Finance and Economics channel, talking about the CPI report and what it really means to everybody. So check my Pharos Finance and Economics channel to see that one come out probably tomorrow, Robert?
Yeah.
Okay, so it's in the middle of edits. It's timely, so it's on the top of the list. The cause of inflation, definitely. If you want to see my take on that, I've got a bunch of videos on the inflation problem and about housing as well. So you can go it's almost a brand new channel, so there aren't hardly any subscribers yet. Definitely don't have to wade through any advertising for it because nothing's monetized yet. So do we have any other questions? Megan's back. That's good. Not the only one that still thinks like a 12-year-old. I would like to think I still think like a 12-year-old sometimes. I don't want to grow up. Heaven forbid, I still don't want to grow up. Yeah, and I play my computer games on my tablet and on my phone all the time. So, yeah, I play a lot. Do we have any other questions? I don't know what time it is. I can't see the time from where I'm at. Robert?
It's 6:45.
6:45? Okay. That is the last topic that I have for today. So let's go ahead and post the question for everybody to take final attendance, Robert. And if everybody could just let me know that you're still here, and you can go ahead and log off, and we'll see you again next week. But please be sure to tell me you're here so that I can give everybody full credit for it, okay? Alrighty, there they come. 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Esteban says that Steve Smith is still here. Good, okay. I forget that Steve is Esteban. Okay.
And we will go ahead and leave the stream
we'll leave the stream live for 15 minutes so you can go ahead and and be sure to get that last credit, okay? So the chat will stay live, but it'll say the stream is ending soon. So we'll see you again next week. Thanks.